Hello and welcome. You're with us here on the Global Reset. You're watching CNBC-TV18 Prime with me, Prashant Nair. This is the program where we try and examine the biggest stories shaping the global economy, politics, society, bringing you expert insights and analysis every day. Well, on the show today, we will be speaking in a moment from now with Albert Park, who is the chief economist at Asian Development Bank. Mr. Park is one of Asia's most authoritative voices on the region's economic trajectory. He anchors the ADB's flagship Asian Development Outlook reports. This year, Mr. Park, of course, has been weighing in. He's been at the forefront of analyzing the fallout from sweeping U.S. tariffs, China's economic deceleration, and, of course, the rising challenge of global economic fragmentation. We'll address each of those points with Mr. Park in just a bit. But as always, before we get to that conversation, let me just quickly get you up to speed with the news, because the news does not stop. And it is fast-flowing. Beginning with news from, of course, the White House. In a policy reversal, almost a policy reversal, U.S. President Donald Trump has announced new weapons for Ukraine. He's threatened to hit buyers of Russian exports with sanctions unless Russia agreed to a peace deal in 50 days. This is a major shift in policy brought on by frustration with Moscow. Take a look at this report.
So in a nutshell, we're going to make top-of-the-line weapons, and they'll be sent to NATO.
President Donald Trump announced on Monday that the U.S. will provide billions of dollars worth of weapons destined for Ukraine, as he voiced frustration with Russian President Vladimir Putin.
We are very unhappy, I am, with Russia.
Sitting beside NATO Secretary General Mark Rutte in the Oval Office, Trump said the weapons would include Patriot air defense missiles and that NATO allies would pay for them.
We are going to be sending them weapons, and they're going to be paying for them.
Patriot missiles in particular are weapons Ukraine has urgently sought to defend its cities from Russian airstrikes. Trump's announcement, greeted with cautious optimism by many Ukrainians, came after Ukraine's emergency services got to work extinguishing fires they say were caused by Russian drone strikes overnight.
I've been hearing so much talk. It's all talk. It's all talk, and then missiles go into Kiev.
Trump on Monday also threatened to hit buyers of Russian exports, including oil, with sanctions unless Russia agrees to a peace deal in 50 days.
And we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. You'd call them secondary tariffs. You know what that means.
A White House official said Trump was referring to 100% tariffs on Russian goods, as well as secondary sanctions on other countries that buy its exports. Putin has yet to accept a proposal from Trump for an unconditional ceasefire, and Russia has used hundreds of drones to attack Ukrainian cities in recent days.
Well, that's the report really summarizing the state of play between, of course, U.S. and its changed posture, changed stance with regard to Russia, Ukraine. Well, meanwhile, U.S. President Trump has said he is also open to trade talks with the European Union and other trading partners as well. Remember, this comes after he announced 30% tariffs on the EU over the weekend.
They're on a more friendly tariff, right? A little bit more friendly tariff.
Perhaps.
No, we're going to be talking to people. We have, I watched the show this morning. They were talking about, well, when's he going to make the deal? The deals are already made. The letters are the deals. The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk. We are open to talk, including to Europe.
Well, markets have been hearing, and they've been holding on very, very well. No big reaction in the first place to those 30% tariffs which were declared over the weekend. In more tariff updates, the U.S. Commerce Department has said that it was withdrawing from a 2019 deal suspending an anti-dumping duty investigation on fresh tomatoes. This is from Mexico, and that it will issue duties of 17% on most of these imports from that country. This comes after U.S. President Trump had separately threatened to impose that 30% tariff rate on imports from Mexico starting the 1st of August, after weeks of negotiation with major U.S. trading partners failed to reach a comprehensive agreement. The agreement, which regulates Mexican tomato exports to the U.S. in a bid to allow U.S. producers to compete fairly, was first struck in 1996 and last renewed in 2019 to avert an anti-dumping investigation and end a tariff dispute. Despite all these tariff threats, the market reaction, of course, has been, as I said, very, very muted, very sanguine looking through all of this. Here's Rockefeller International's Ruchir Sharma explaining why.
US is concerned, I think what's going on is that some of the exporters this time, particularly the Chinese, appear to be absorbing a lot more of the costs than they did, let's say, last time in 2019 when they faced higher tariffs. The second thing which is happening in the US is obviously the AI mania. The animal spirits coming from that is offsetting any hit that's coming from the tariffs, and that we can see even the sector breakdown of what's outperforming in the US market. And if there's any other factor out there, which is also that the fiscal bill, which was just passed, that has some tax cuts in there. So the corporates, it gives them the better ability to absorb some of the tariff hits. Even after these deals are done, the tariff rates are still likely to be at least 10 percentage points higher. Now, at the beginning of the year, most economists told us that if you end up with tariff rates which are 10 percentage points higher, the hit to GDP growth would be about 1%. That's not happening. I think that's the bigger mystery. And that's what's, I think, in terms of this combination of AI, the animal spirits coming from that, and also that the foreigners, at least for now, are absorbing a large part of these, or at least 20 to 30% of the tariff increases. I think those are the two surprises, which is what has kept the market be pretty resilient.
Let's also listen to Ed Yadini, president of Yadini Research, who says that the market is now used to these uncertainties. He expects the whole tariff issue to be sort of resolved by the end of the summer. Listen in.
The markets have gotten used to that uncertainty. The president obviously on a daily basis can change his mind about what happens with tariffs. And a lot of what he's doing is viewed as negotiating tactics. I think this whole issue will more or less pass by the end of the summer. I think the administration surely recognizes that they can't really afford to take a risk of pushing the economy into recession later this year into next year when the midterms are not that far off. So I'm in agreement with the market's assessment that this too shall pass and that the tariff issue will be resolved to a large extent.
Let's go across to Albert Park now. He's chief economist at the Asian Development Bank. Mr. Park, great to have you with us here on the program. Thank you very much. And thank you for waiting as we were sort of kind of running through a lot of the news flow. And there is, as Ed Yadini just said, so much to tackle on a daily basis, right? So my simple first question is, do you start making changes to estimates, revising estimates every time you hear something from President Trump, or like markets, you're kind of sort of giving it time now? Let's see how this settles one way or the other before you put pen to paper.
As you know, at the Asian Development Bank, we update our outlook for growth and inflation in the region quarterly. The last time we issued a forecast was in early April, really reflecting pre-Liberation Day world. And at that time, we were fairly optimistic about growth in the region. Asia Pacific, including 48 member countries in Asia that ADB works with, we expected to grow at 4.9% this year and 4.7% next year. Given all of the trade uncertainty, though, we're already starting to see real effects on the economy. We're seeing purchasing manager indices really declining pretty sharply in a number of key export economies in the region. We're very likely to be downgrading our growth forecast for the region moderately when we release new forecasts next week for Asia Pacific. And that's partly because of the higher tariffs that are already in place relative to what we saw earlier in the year, but also just the uncertainty itself has made it very difficult for investors to have the same amount of conviction and enthusiasm for making long-term investments.
So next week we will get those new estimates. So these are quarterly. You make these changes, fine-tune them quarterly. Most likely some downward changes. And this is for Asia, right, Mr. Park?
Yes, this is for the Asia-Pacific region. We cover countries ranging from Central Asia and the Caucasus to the Pacific Islands, and of course South Asia, Southeast Asia, and East Asia.
So, and in terms of country level implications, I mean, there'll be country level estimates as well. What would, I mean, what is on the severe spectrum? What is on the mild spectrum? If you could give us a sense. Of course, we'll wait for the final report and the changes as they come out next week. But if you could give us a sense.
Right. I think not surprisingly, the regions in Asia that are more reliant on exports and manufacturing are being downgraded more. So probably some of the key economies in Southeast Asia, India as well, because it's a major economy. I think we're also seeing some caution. So probably growth will be a bit slower. And of course, China, it's been kind of back and forth. The government has been providing some stimulus to the economy, but they've also faced trade headwinds with up and down negotiations with the U.S. The current agreement increases tariffs on China moderately. We actually still think China's growth this year will be about 4.7%, declining to 4.3% next year.
I got that. By the way, where does the, of course, it's up in the air what end state tariffs, U.S. tariffs will look like by the time everything is said and done. But do you think, even from April, because what we've heard over the weekend and, that number is, what I picked up was, end state tariffs could be between 10 and 15%, but that may be closer to 20% now. The way it is going, would you agree with that assessment, Mr. Pak?
Well, again, there's so much uncertainty, it's hard to have much conviction about where this is going to end up. We do know that as we're talking today, the real kind of import tariff rate for U.S. imports has jumped all the way up to 17%. That's for global exposure. In the region, of course, everyone is facing at least a 10% increase. So where it ends up, we'll see. I think, given, as you described, kind of the fairly muted market response to all of this uncertainty, it does seem that the market is expecting a lot of these threatened tariff rates not to materialize. And so they may be underpricing kind of the risk of really high tariffs being imposed on a number of major economies in the region, which would definitely, I think, lead to lower growth. And also, I think, eventually, once they realize, would create a market response, since it doesn't seem to be the most anticipated scenario right now.
There was one viewpoint back in April before the reciprocal tariffs, the Liberation Day tariffs were announced, that maybe it was a minority view, but maybe if tariffs go up on a reciprocal basis for everybody, who knows, maybe, if it'll spur trading activity, etc. But of course, I mean, the tariffs were not reciprocal. The formula uses, but that's all ancient history now. We are, of course, moving forward with the new announcements, new proclamants every second day. We'll take a quick commercial break here. Mr. Park, of course, is with us. We continue this conversation on the other side. Stay tuned. Welcome back. You're with us here on CNBC-TV18 Prime. You're watching the Global Reset. We're in conversation with the Chief Economist at the Asian Development Bank, Albert Parker. Mr. Parker, thanks for staying on. Let's come to India specifically. Here in India, a lot of expectation when all of this started, the tariffs talk started, that the country would be perhaps one of the first to kind of strike a deal. We heard sound bites from President Trump. We had sort of optimistic commentary from India, but nothing yet. Nothing so far. As an economist in the region, how important is this deal for India? We're not a big exporter to the US in that sense. I mean, it's a domestic-facing economy to a very large degree. How do you view this?
Well, I think, India is in the same boat as many other countries that have been negotiating with the US, hoping to strike a deal, but then having some difficulty closing it. I think one kind of positive aspect of the Indian negotiation with the US, I think it has furthered internal debate about whether India should do more to liberalize its trade and reduce its own import tariffs, which we think is actually a good thing for the government to promote competitiveness by reducing import tariffs. That would be good for Indian growth. But you're right. Overall, India's export reliance on the U.S. is somewhat limited. Nonetheless, I think it is affecting investor confidence and sentiment, so it's still important. And more broadly, we still see growth in India still being fairly robust. You know, it's still one of the fastest growing regions one of the fastest growing countries in all of Asia Pacific. We expect it to grow well above 6% this year and next year. And so there is still very robust domestic demand, domestic investment, demographic, favorable trends that should support growth in India.
Got it. You know, as an economist, Mr. Park, I mean, here in India, the government has been trying over the last couple of years a lot of initiatives to help manufacturing sort of come up in a big way. And this entire China plus one was a big kind of push as well. Basically, businesses diversifying their exposure to one country, one region. During Trump 1.0, the two countries which benefited enormously were Vietnam and Cambodia. What is your sense as you kind of sort of assess prospects in terms of growth for a country like India? Is the country doing the right things to attract a lot of manufacturing? Is China going to protect its stuff? I mean, I just wanted your view on how this is playing out, because we are hearing companies vocally express their opinion once in a while as well. I mean, we heard from Apple, for example, recently. Go on.
Right. Well, you know, the China plus one strategy cannot work for all countries. You still have to be a very competitive economy in terms of your tariff structures, in terms of your infrastructure, logistics, stability, the quality of your workforce. As companies think about relocating activity away from China or really anywhere to new economies, they're looking at the competitive environment. So it's still, I think, in India's best interest to focus on those really fundamental aspects of improving the business environment, still reducing regulatory barriers, making it easy, especially for foreign investment. Sometimes it seems like every state you have to have a different set of negotiations to do business in India. And so I think that is a priority. Of course, there's also been some subsidy schemes trying to attract foreign investment. That sometimes can help in the short run, but if you can't really create a competitive environment, I think the effectiveness of those types of strategies are less likely to be effective in the long run. I think it's also important for India and any country as it tries to think about what are the industries it would like to develop, to really focus on the ones that they have some capabilities in, they have comparative advantage, it builds on existing strengths. So for instance, obviously India has been very strong in pharmaceuticals and some IT sectors. So I think it also makes sense to build upon success and things about, and then really focus on having a dialogue with businesses in those leading companies in those sectors to really understand what are the remaining barriers that are preventing faster growth and more rapid investment. To be competitive in today's global economy, there's no shortcuts. It still requires this kind of systematic investments in a sound, a competitive environment, and in correctly identifying and supporting the industries that can drive success.
You know, let's just sort of wind this down with a quick comment on China as well, Mr. Park. We had the second quarter numbers coming through, GDP numbers coming through for China this morning. But my question so much is not about growth, which of course, I mean, the authorities are trying to boost through all these measures. My question really is, what about the US-China deal itself? I mean, you know, if there is one country which President Trump has sort of, you know, singled out, and there's this almost strategic competition going on in many areas, is with China. What kind of strategies will China use, you think, to protect its stuff if access to the US market becomes very expensive, are we going to see Chinese products, I mean, still the factory of the world, show up in many other parts of the world? What is the second order impact of this, this competition between US and China, this rivalry between US and China?
Right. Obviously, that rivalry is occurring across many different fronts, not just in terms of trade, but also in terms of technology restrictions, et cetera. For China, since the first U.S.-China trade war during the first Trump administration, China has been steadily reducing its exports to the U.S. and so is much less dependent on U.S. export markets than before. However, one thing that we've seen very clearly is that China has increased its exports, especially of intermediate inputs, to other parts of the world, in particular Southeast Asia, but also Mexico and also other kind of hub economies, if you will. And those countries have been increasing exports to the U.S. to replace the declining Chinese exports. And one aspect of the U.S.-Vietnam trade deal was a specification that rerouted trade would be taxed at a 40% rate to try to target this channel through which China could still maintain linkages to the U.S. export market through third-party countries. The more that happens, of course, the more challenging it will be for China to respond to. And of course, that is also very bad news for economies like Vietnam that have benefited from this type of trade. And it's also, to be honest, bad news for the U.S. because it means that there will be very few channels to maintain lower cost production of many goods that they're importing. And so you would see much higher import prices. So those are all challenges. I think China continues to try to support its economy. It has other headwinds. Productivity growth in China has been slowing pretty steadily since the global financial crisis over a decade ago. And as we all know, they're also facing a property market slowdown, which has been a very strong headwind towards growth and consumer confidence. And that is the result of other kind of structural problems based on Chinese institutions that really supported overinvestment in real estate in previous periods.
Mr. Park, very, very contextual, incisive answers. Thank you very much for joining us. It's a pleasure having you with us here on CNBC TV 18 Prime. And I hope this is the first of many conversations. Hope to speak with you once those, that quarterly report is released. So look forward. Thank you very much once again.
Great. Happy to be here. Thanks.
Okay, well, let's move on to some global, local news. Tesla is officially debuting here in the Indian market with the launch of its first showroom, also known as the Tesla Experience Center in Mumbai's Bandra Kurla complex. Welcoming the global car maker, Maharashtra Chief Minister Devendra Fadnavis said, and I quote, "This is not just the inauguration of an experience center, but a statement that Tesla has arrived in the right city and state." The company has officially listed its electric SUV, two variants of the Model Y, on its India-dedicated web page. The rear-wheel drive variant priced at 59.89 lakhs, while the long-range variant is priced at 67.89 lakh rupees. With premium rivals like Mercedes-Benz, BMW, Audi and BYD strengthening their electric offerings in India, Tesla's price band of 60 to 70 lakh rupees puts the model in competition with not just high-end EVs, but also luxury ICE SUVs. Remember, Tesla's move comes at a time when the Indian government has introduced a new EV policy allowing lower import duties for automakers committing to local manufacturing within 3 years. Okay, well, Tesla is finally here in Mumbai. With that, it's a wrap on this edition of the Global Reset. Thank you very much for staying with me. More coming up on the other side.